Welcome to the Deep Dive. Today, we are cracking open the Q3 2025 earnings conference call from Badger Meter. That happened just yesterday, October 21st. And we've got a classic case study here, almost like market cognitive dissonance.
It really is. It's this paradox, isn't it? Management delivered, a textbook financial beat. They actually increased their long-term structural margin expectations, highlighted all the tailwinds in the utility sector.
And yet the market just absolutely sold off the stock. Shares dropped, over 5%? And the volume was huge, like three and a half times normal.
Yeah.
So a clean beat somehow gets punished.
Yeah, exactly. So our mission today is pretty simple, really. We need to fully unpack those, outstanding fundamentals. We need to weigh management's confidence, which sounds immense, against the actual numbers they put up.
And try to figure out what drove that selling pressure. What was the market so afraid of in the short term?
Right, because when a company like this, a key infrastructure player, posts strong numbers but still gets hammered, well, that disconnect, that's often where the actionable insight lies for you, the listener. So let's just jump straight into the results snapshot.
Okay, let's unpack the headlines. Badger Meter delivered GAAP earnings per share of $1.19. That was a solid, 5 cents above the high end of consensus. Expectations were around $1.11 to $1.14.
Pretty significant beat there. And the top line was just as compelling, really. Revenue came in at $295.7 million. That also crushed the high end of estimates. And it represents pretty robust 13% year-over-year growth.
And the profitability story looked excellent, too. It really showed genuine underlying strength. Gross margin expanded 50 basis points year over year, up to 40.7%. But here's the real kicker, I think, for financial resiliency. They posted record free cash flow, $51.3 million. That is, we can sleep well at night kind of money.
Absolutely. Now, let's dig into that 13% total growth rate a bit more, because it wasn't just M&A driving it. The base sale, so if you exclude the SmartCover acquisition they closed back in January, still grew a very solid 8% year over year. That's pure organic momentum.
Right. And management specifically called out their key product drivers for that. Strong demand for cellular AMI, the advanced metering infrastructure, also their BlueEdge suite, so smart water solutions, and the high-margin subscription revenue from BEACON SaaS. Seems like the shift to digital is absolutely accelerating.
And this brings up the strategic value of SmartCover, which, focuses on wastewater monitoring. They said it's being integrated well, and the implied growth for that specific segment was roughly 25% in the quarter. What's fascinating here, I think, is the synergy. SmartCover is critical because it pushes Badger Meter beyond just, counting water drops into the broader, probably higher value water quality and network monitoring ecosystem.
Right, moving up the value chain.
Exactly. And management confirmed SmartCover is still focused on growth, and they still expect it to be EPS accretive in year 2, so 2026.
Okay, now here's where it gets really interesting for me, the structural margin story. Management didn't just meet expectations. They seem to have permanently reset the profitability ceiling. They raised their long-term normalized gross margin range to 39-42%. That's up from the historical 38-40% range. That's a huge signal of internal confidence, isn't it?
It really is, and it raises that important question. Why is this structural, not just temporary? Think about it this way. Their pricing actions, the ones that started back in Q2, those were kind of like putting a targeted bandage on a leaky pipe, right? To mitigate cost pressure.
Okay.
Those were more temporary fixes for tariffs and the cost inflation in materials like bismuth, that metal used in brass alloys for plumbing.
Makes sense. They had to cover input cost spikes.
Exactly. But this new 39% to 42% margin floor, it isn't based on those pricing bandages. It feels more like they're saying they've permanently replaced the old pipe with a brand new, higher quality one. The structural benefit comes from a lasting mix shift towards inherently higher margin products.
Well, like that specifically.
Specifically, the Orion cellular radios, the E-series ultrasonic meters, and of course, the growth of their software solutions, the SaaS stuff. Management is saying this is a permanent mix shift, not just some temporary pricing lift that'll fade.
Okay, that's a key distinction. And we also saw pretty powerful underlying operating leverage, didn't we? While the consolidated operating margin expanded, I think it was 10 basis points. The base operating margin, if you strip out the cost of integrating SmartCover, that expanded by a full 120 basis points to 20.7%. That shows they really nailed the execution in the core utility segment.
Yeah, really strong underlying performance. Now, let's zoom out a bit to the long view. Management reiterated their multi-year target, high single-digit average top-line growth. And they confirmed this outlook is purely organic, meaning it excludes any future acquisitions. That's a massive commitment in this kind of industry.
And it seems to be driven by these deep customer themes you need to remember if you're following this space. Utility customers are apparently desperately prioritizing tech adoption. Why? Largely due to persistent labor challenges.
Yep. They just can't find the people.
Exactly. So they simply need smart technology to do the work that traditional staff used to do. And this urgency reinforces demand for things like their modular solutions, like BlueEdge. It lets utilities phase in resiliency and efficiency upgrades over time.
They did address investor concerns about the sequential performance too.
Okay.
Management explicitly called out that the sequential dip in sales from Q2 to Q3, well, that was expected, it was normal, all down to project timing, specifically with large utility contracts.
But, for a growth investor, any sequential drop raises eyebrows. Did they offer any evidence beyond just saying, oh, it's project timing?
Well, they basically leaned on their history and industry knowledge, emphasized that, look, large contract timing always introduces some unevenness. It's just the nature of the beast. And that the macro drivers, things like labor shortages, mandatory infrastructure upgrades, those are far more meaningful than any short-term project slip.
Okay.
They also kind of downplayed the role of federal funding, like ARPA money. They basically said genuine infrastructure necessity is driving adoption, not some temporary government stimulus check.
I see. And they also pushed back hard on comparisons to 2011, didn't they? When organic sales actually dipped. Their argument is the industry is fundamentally different now. It's shifted entirely away from old mechanical meters towards software and battery-operated AMI. Mm-hmm. So they feel those historical comparisons are irrelevant today.
Yeah, that was a strong pushback. And their capital allocation strategy seems to back up their confidence. Still focused on R&D, continuous dividend increases. I mean, they just raised it 18% for the 33rd consecutive year. That's an incredible streak.
Wow, 33 years.
And disciplined M&A, of course. All of this is underpinned by, substantial financial flexibility. They mentioned having approximately $200 million in net cash on the balance sheet.
Okay, so let's put it all together. We have a company executing flawlessly, seemingly. Sitting on $200 million in net cash, they're raising long-term margin guidance, confirming multi-year organic growth. Management sounds completely unshakable. So if they're so confident, why on earth did the market immediately bail, knocking the stock down over 5%? What gives?
This is the million-dollar question, right? The critical disconnect. The market seems fixated on maybe two things. First, near-term valuation. The stock is historically traded at a premium. And second, maybe some short-term noise, like that standard Q4 reminder, that the final quarter just has about 5% fewer operating days because of utility holiday schedules. It's normal seasonality.
Wait a second, though. If the stock was already trading at a premium, isn't the market actually right to punish it for valuation, even with good results? Like, where is the floor for a stock that raises guidance but still trades at a multiple company? The market seems increasingly uncomfortable paying.
Well, that's the tension, isn't it? The market seems to be ignoring the fundamental fact that the company just structurally upgraded its operating model, its profitability profile. When you look at the fundamental metrics that record cash flow, the structural margin improvement we discuss it suggests this current pullback is probably driven more by multiple compression fears rather than any real worry about operational execution.
All right, let's pivot. Time for our segment. This is not financial advice. We're going to put on our analyst hats for a moment, pitch an outrageous but plausible trade idea based purely on this earnings context, arguing for the fundamental strength over the market's short-term freakout.
Okay, lay it on us. The context, just to recap, is the stock is now trading at some of its lowest valuation multiples in recent memory. Despite the confirmed structural strength, despite that huge $200 million net cash position.
Exactly. So here's the pitch. Given that cash reserve and the, frankly, irrational-looking post-print drawdown, we should execute a synthetic short put strategy, specifically shorting a December out-of-the-money put option.
Okay, hold on. For those listening who aren't deep in the derivatives world, what does that actually mean in plain English? What's the bet?
It means we are essentially selling insurance on the stock. We're betting that management, with all that cash and confidence, won't let the stock fall below a certain line, our chosen strike price. We sell the option contract, we collect the premium income right away, up front. And we only assume the obligation to actually buy the stock if, and only if, it drops down to that much lower, more favorable strike price by the December expiration date.
Okay, I get the mechanics, but why is that plausible here? Why bet on management stepping in?
Because we are betting that the company's capital allocation priorities, while historically focused on M&A and dividends, might slightly shift, just slightly, to take advantage of this suddenly discounted valuation in their own stock. Imagine a small, targeted share repurchase announced sometime in the coming weeks. It would be a powerful signal of confidence, and it would almost certainly stabilize the stock well above our chosen out-of-the-money strike price. So we're basically leveraging the company's confirmed resiliency, that margin of safety, from the huge cash balance to try and pocket that option premium.
A leveraged bet on management's confidence and their financial stability matching their rhetoric. I like that. It integrates the strategy and the potential trade execution nicely.
So just to summarize this deep dive, it really confirmed that Badger Meter executed, well, a textbook quarter, driven by a powerful and seemingly permanent structural mix shift toward higher margin stuff, ultrasonic meters, software. And they managed costs effectively, leading directly to that raised, higher long-term margin outlook.
Yeah, this is really a story of a business model successfully transitioning, isn't it? Moving away from just lower margin hardware and really fully digitizing the water cycle, supported by that critical, non-cyclical utility demand.
So what does this all mean for you, the listener? Given management's strong emphasis on augmenting their capabilities in water quality and network monitoring, and remembering they have that significant net cash position, here's a final provocative thought for you to mull over. The industry is facing massive new regulatory challenges, especially around forever chemicals, right? PFAS, PFOS. Which specific technological niche may be one they've explicitly avoided so far, like advanced PFOS testing tech, or maybe remediation monitoring might become their next value-added inorganic growth target, especially now that their balance sheet gives them such immense financial flexibility to make a move.
That's interesting. That would certainly shift the conversation even further from just metering towards actual compliance and treatment monitoring. Definitely something to ponder as they continue acquiring these capabilities beyond the meter itself.
That's all for this deep dive. Thank you for joining us. We'll catch you next time.